The cap rate is the unleveraged rate of return you can expect to get in a particular area.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association, providing benefits and services to real estate investors and rental property owners for over 45 years. With your host, Brian Hamrick from Hamrick Investment Group.
Hello and welcome to episode 25. So today is July 4th, 2016. And I want to wish all of you a happy 4th of July. Now, typically on Mondays, I like to come out with a new interview, but because it is a holiday, our listenership is obviously way down. So I didn't want to air an interview with one of our excellent guests because I know that a lot of you just won't be able to listen to it because of the holidays. Instead, I'm going to take this opportunity to talk about a key financial ratio that is used quite often in real estate investing, especially commercial real estate investing, that it's thrown around a lot, but not everybody understands what it actually means. And I'm talking about the capitalization rate, or cap rate for short. So you might hear a broker say, hey, we're selling it at an 8 cap or a 7 cap. Properties in California or Los Angeles are selling at a 4 cap, but you can buy a property here in Michigan at a 9 cap. What does that really mean? And I teach a class called Advanced Financial Analysis. And when I get to the section on cap rates, I always ask the people in attendance, hey, who can explain to me what a cap rate really is? And 95% of the time, I am met with stone silence. So today, I am going to go through several explanations of what cap rate is. I'm going to give you the technical definition out of the book that I have sitting right next to me here. I'm going to give you the mathematical equation. And then I'm going to tell you how I like to think of cap rate, which I think is going to be much easier for a lot of you to understand. So for those of you who insist on accuracy and getting things right, I'm going to start with the technical definition of cap rate that I'm getting out of a book that I have right here called The Real Estate Investor's Pocket Calculator. Simple Ways to Compute Cash Flow, Value, Return, and Other Key Financial Measurements. It's by Michael C. Tomset. And I just happen to have it on my bookshelf. So I open up to the technical definition of cap rate. And here's what it says. Cap rate is the capitalization rate, or the return generated by income properties. It compares net operating income to sale prices to estimate value based on a comparison with similar properties in the same area. That is the definition out of this book. Now, part of the problem with definitions out of books is they may be accurate, but it's very hard for me to get my head around that definition. Okay, and I think a lot of people feel the same way. I want to break it down in a much more simple way for you to understand. But before I do that, I want to give you the mathematical equation, because cap rate is part of a mathematical equation. So here it is. Cap rate equals the net operating income divided by the fair market value. That is the mathematical equation for cap rate. Cap rate equals net operating income divided by fair market value. All right. So there's two definitions, but now the third definition, this is my definition. And it may not be technically accurate, but this is how I think of cap rate. And I think for those of you who find the other definitions confusing, you will find my definition very, very helpful. Basically, the cap rate is the unleveraged rate of return you can expect to get in a particular area. The cap rate is the unleveraged rate of return you can expect in a particular area. So let's break that down. Unleveraged rate of return. Unleveraged means there's no loan. You're paying all cash. So if you have $100,000 and you invest in a particular neighborhood, what rate of return do you expect to get from that $100,000? So let me give you an example. We live in Grand Rapids here, and if I invest in a duplex and I pay all cash, $100,000 for that duplex, and that duplex is located downtown in a very good neighborhood, in a walkable community, and it's going to attract good renters and good income. What kind of return on investment should I expect on that $100,000 that I paid all cash for that property? Well, in today's market, given the conditions, and just based on how much people are paying for properties, you could expect to get a 6 to 7% return. Okay, this is for a very good duplex in a very good area for $100,000. All right, so that 6 or 7% return is the cap rate, unleveraged, in that you're paying all cash, rate of return in a particular neighborhood. If you're getting a 6 to 7% cap rate on your $100,000, that means after a 12-month period, you're putting $6,000 to $7,000 in your pocket. Okay, so now let's look at a different neighborhood. Let's say we go further away from the city center and we go into what's a not very good neighborhood. You know, a neighborhood where you might have more police activity, maybe some drug activity. Maybe it's been in the news because there's been some violence or whatever. You're in a rougher neighborhood. What kind of return are you going to expect on your $100,000 if you buy a $100,000 property in that neighborhood? What kind of return are you going to expect on that? You're going to want a higher return, aren't you? You're going to want something that, you know, is probably above a 10% return. If it's a real rough neighborhood, you're probably going to want a 15 to 20% return because you're taking on greater risk. So the cap rate you're looking for will be anywhere from, 12 to 14 to 15, all the way up to 20% return. And that's the cap rate. That would mean that after a 12-month period, if you invest $100,000 all cash in a rougher neighborhood, and let's say you invest that cash at a 15% cap rate, that means at the end of the year, you would be putting $15,000 into your pocket. Okay, that's basically what cap rate means. And what happens, and there's an inverse relationship between cap rate and fair market value, because as cap rate goes up, the value of the property goes down. So if you're in a not so good neighborhood, you're going to want a higher cap rate and you're going to pay a lower price. If you're in a very good neighborhood with lots of renters and lots of people who want to live there, then you're going to most likely pay a lower cap rate and a higher price. So there's an inverse relationship there. Now let's kind of break the technical definition here. And let's just say you have $100,000 and you say, well, I'm going to put this $100,000 into a savings account at the bank. Well, what kind of rate of return are you going to get on that $100,000? If you're lucky, you'll probably get 1% return. At the end of a 12-month period, you're going to put $1,000 in your pocket. Essentially, that's a one cap. You're getting a 1% return on your all cash investment. Let's say you put it in a 5-year CD and you're guaranteed 3% return. Well, essentially, that's a 3 cap. Now, obviously, you're not investing in real estate, so technically, I don't know if you can call it a capitalization rate, but that's the way I want you to think of it. It's like, what kind of return can you get on your all cash investment? That is what a cap rate is. As you take on more risk, that cap rate keeps going up and the value of the property goes down. It's an inverse relationship. Currently, interest rates are very low. So there's a lot of money coming into rental real estate and it's driving the prices up and the cap rates down. Eventually, and who knows how long it's going to be, 6 months, 2 years, 6 years, interest rates will start to climb again. Now, there's not a direct correlation between interest rates and cap rates, but you can reasonably assume that as money becomes more expensive to borrow, it's going to push prices down and cap rates will start to rise. So I hope that makes sense. I also want to talk about the 5 factors that influence cap rate, okay, because it's not all tied to interest rates, like I said. Risk is the number one factor that influences cap rates. So as you decrease your risk, you are also lowering the cap rate and increasing the value of the home. If you're going into a riskier neighborhood, a more dangerous neighborhood, where you have to worry about crime or violence, well, your cap rate's going to go up. The cap rate's going to go up, and the value of the property you are buying or selling is going to go down. Risk influences cap rate. The lending environment and interest rates influence cap rate, and I just talked about that. Liquidity. How easy is it going to be to sell your property? Well, right now in Grand Rapids, you can sell a rental property very easily if it's priced right. That affects the cap rate. And if you go to the A markets like New York, Los Angeles, Chicago, properties are very liquid because so many people want to buy them. So it has a compression effect on the cap rates. The cap rates go down because it's very easy to sell a property. Values are much higher in the A markets. You go out to a tertiary market, to a market that's much smaller. Like take, for example, Sparta or Newaygo. For those of us in West Michigan, you know what I'm talking about. They're smaller communities. There's not as many people buying there. That's going to affect cap rate. If it's harder to sell your property, very likely then you're going to have higher cap rates and lower prices. Current tax code also affects cap rates. Depending on how the government decides they want to tax certain things, that can have an effect on what people are willing to pay for properties. If the government decides to get rid of some of the loopholes of investing in real estate, well, that could bring about a decrease in the value of these properties as well as an increase in the cap rate. And then finally, appreciation. How quickly do properties appreciate in a given area? Well, if you're in Los Angeles or San Francisco, you're seeing huge appreciation on properties. That affects the cap rate. People are paying 3%, 4%, 5% cap rates in those cities, which in turn drives up the prices. But if you're in a community where the appreciation is increasing at 2%, maybe 3% a year, well, that's going to affect the cap rates as well. Home values or property values will remain somewhat consistent. Cap rates will probably be higher than what you find in the major cities. So that's my conversation on cap rates. I hope it helps. I hope you think of cap rates as the rate of return you would expect in a particular area if you make an all-cash investment. Thanks for listening. I hope you have a great 4th of July and 4th of July week, and we'll be back again next week with a brand new interview.
You've been listening to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association. You can find out more at rpoaonline.org. If you enjoyed this podcast, please go to iTunes to subscribe, rate, and review.